All right, good morning, everybody. Welcome to the January 2025 Altos HousingWire webinar. There are a ton of things going on in the market right now. Our headline is that sales are really ticking down with 7% mortgage rates. And we're going to explore the sales, we're going to explore inventory and a bunch of other things in the data today. Some interesting local market differences. And we're going to revisit some of the forecasts that we've made for the year. So much going on. For those of you who are new to our webinar, I'm Mike Simonsen. I'm the president of Altos Research. We're part of HousingWire. And at Altos Research, we track every home for sale in the country every week. We track all the pricing, all the supply and demand, all the changes in that data, all the sales. And that's what we're diving into here. You can connect with us each week with a video on Mondays, or you can spend an hour with us where we do all the details here. So let's dive in to what we know, the first signals for 2025 already. Four big questions for today. Sales are down in January, and they are down from last year. So we're going to look at what that means and try to figure out what's next. We have seen inventory growing through the year, all last year. And the question is, will that keep growing? And where is that going to, which are the regional markets where that's going to change? If inventory is growing and sales are down, the question is, can prices hold up? There are some changing signals on home prices now. And then another question, which I'm not sure I can answer, in fact, I'm not sure anyone can answer, is what's going to happen with mortgage rates? Will they ever come down? So these are things that we are exploring in the data today. And we will, as always, talk about how you can talk about the market with your clients, your buyers and sellers right now. And we will spend the second half of the session in the local markets. Some of the local markets are behaving very differently from each other. Some are pretty strong and some are not that strong. Some have the weaknesses. So we're going to do some local market exploration as well. In the chat, we'll have Jeff and Lael from the Altos HousingWire team, and they'll be answering questions and sharing links. So have the chat open, and and then at the end, I will stick around and make sure all the chats, all the questions are finalized, but I can't do them while we're talking. All right, let's dive in. Before we look at data, I want to announce that we have at HousingWire the Housing Economics Summit. It's February 26th in Dallas. It's a one-day conference, and I will be doing the live talk with the latest data. We'll have more than just me, though. We have Logan Motashami from the HousingWire team. We have a bunch of interesting thinkers, economists. We have folks from the mortgage industry. And if you're in Dallas or you want to head to Dallas, you can join us at the Housing Economics Summit. These are the biggest, that's the best minds in real estate and mortgage, analyzing what's happening and sharing what they can see in the housing and mortgage markets today. That's February 26th in Dallas. There will be a link in the chat. If you want to register to that, you can come and join us. There'll be a link in the chat. You can click through and join us in Dallas at the end of February. Love to see you there and shake hands and chat face to face. So that's just a quick announcement. All right, let's roll into mortgage rates. Mortgage rates are still, the 30-year fixed rate is still over 7%. And we are obviously seeing the implications of that now. In this view, this is like 14, 15 years, 13, 14, 15 years of mortgage rates. Each dot on there is a week, the average rate for the week. And the little purple cloud is where the year spent in terms of rates available for home buyers. You can see most of the decade, 4.5 or lower. 2018, right in the middle of the chart there, rates were higher, and that had a slowing effect on the market until the spring of 2019 when rates started falling again. You have the big stretch in the middle, which is 2022. That's when rates went from 3% all the way up to 7.5% that year and really put the brakes on. Then in the last 3 years, we've had this range, 6 to 8%. Right now, we're hovering around 7% mortgage rates. And when we at HousingWire forecasted mortgage rates for the year for 2025, it seemed obvious that rates could end up above 7%. Some strong economic news, some slightly resilient inflation numbers, suddenly the bond market pushes higher, and that pushes the 30-year fixed rate above 7%. It seemed quite possible to us, and suddenly we are already there. Most mortgage rate forecasters were expecting rates to stay in the sixes all year. And while I still think that we'll probably spend most of the year in the sixes, there are some scenarios that still push rates higher from here. And so we should be prepared, especially with buyers and sellers, to that is not necessary. It's not a foregone conclusion that if you wait till the end of the year, that suddenly you're going to be paying 5.8% on your mortgage. That is not at all clear. And I think it's evident when you look at the data this way that, coming into 22, we knew rates would climb, but nobody saw 7.5. Then at the end of 22, people were assuming rates would fall back down into the fives. Nobody saw 8%. Then by 24, now we were saying, okay, there were still people who said maybe the peak is past. Now we're in 25, we're still above 7%. So the lesson is that if there are buyers and sellers sitting on the sidelines waiting for cheaper rates, they may have to wait a long time. Now, on the other hand, we do see scenarios where if we get lucky with some economic news, and the spreads between the 30-year fixed and the 10-year bond collapse a little bit, close a little bit, there are scenarios where rates could get back down around 6%, like they did last September, and maybe even duck under 6% if we're lucky. And the lesson there is that in September, when rates moved close to 6%, we could obviously see home sales and demand ticking up. And right now, as rates are over 7%, we can obviously see home sales and demand ticking down. So it is something to keep in mind. And when I say obviously ticking down, I'm just going to start today looking at the weekly contracts pending, the new sales. So the offers getting made, these are the houses going into contract. This is looking at single family homes. We're just in the third week of January, 45,000 new contracts pending for single family homes. And in this chart, there's the bright blue line is last year, the little lavender line is 2023. At the left end of the chart there, the dark blue, the navy line there is 2025. And you can see that started out below the last few years, and this week ticked off to the side. And so sales this week, new sales, new contracts started, were 10% below the same week a year ago. Normally this time of year, there's inventory, there's fresh inventory, people start buying, and the sales rate starts ticking up. And as of right now, these are signals that consumers are waiting. Now, this has been what's interesting. You look at the right end of the chart here, the bright blue line from 2024 was consistently above the year prior. 5, 6, 8%, sometimes 10% more sales in a given week in the fourth quarter of 24 than 23. We could see the sales growing. In December, rates spiked back up over 7%, and then those gains evaporated. So that's what we're looking at right now. Now it's early in the year, and I'll show our forecast later on, but we forecast that home sales will grow about 5% this year, from 4 million to 4.2 million across the country. And so I still expect that will happen. We still are expecting that we'll see some sales gains during the year, but as of January, we're starting in a hole. So that means, as rates come down during the year, that if we're lucky and rates come down during the year, that stimulates some sales and we see some of that sales growth. I do think that there are a lot of folks who've been sitting on the sidelines for several years waiting for the opportunity to open, and we had a 3-week window in September when rates dropped, and then they jump back up again. So it'll be really fascinating to see how quickly consumers respond. They didn't respond at 6.5%. So you can look at June and July last year when sales were not up over 2024, right in the middle of the chart, 24 over 23. But then by September, we could see sales growth. So that's where our expectations are for the year. If you look at the Mortgage Bankers Association, they do their purchase mortgage applications each week. And you can see the same pattern. Their 2024 line in October, November, December was above 23 at the right end of the chart. And this week and the last few weeks, their purchase mortgage applications have been below 2024 and 23. That's something, so it's really interesting to see both our data and the MBA data kind of working in the same pattern. And it's really obvious how sensitive consumers are to 7% mortgage rates. Okay, let's switch now to inventory, where we usually start the webinar. I started on kind of a bearish note, but we'll switch back to inventory. There are now 632,000 single-family homes unsold on the market around the U.S. That ticked up a little bit for the week. Will probably tick down next week. You can see here 10 years of inventory cycles. Each year we're in the low in January and February, and then sometime in February, usually by the second or third week of February, inventory starts ticking up for the season. In the last couple years, in the pandemic time, when demand was greater than supply, we could see that the low point of inventory didn't actually hit until late March or even April. And so inventory, there was more demand than supply. So we kept buying during the pandemic. So the normal season was shifted late. What'll be interesting, what we're watching for in the next few weeks is that normally in February, you get some uptick, some downtick, you get weather, we get all kinds of things we get that would make it's still winter. So we would make the spring inventory not really start rising until, say, February. If we get inventory rising next week, the next several weeks in a row, that'll be a signal about demand in this current 7% mortgage rate environment. There are now almost 25% more homes on the market unsold than a year ago. I've highlighted here last year, there's a vertical bar for last year, and also back in January of 2018. 2018, where we started 2018, so there's about, I think it's about 17%, 18% fewer homes now than in 2018. So by the end of the year, we could get back to the old normal levels of inventory, that 2018, 2019 level. If you notice in here at that 2018 to 2019 bump, because mortgage rates were rising in 2018, inventory was rising relatively. And then January of 2019 started with more homes on the market. So we had a little bit of home rise because rates rose that year. Then as the economy was cooling, the Fed started cutting rates started falling in 2019. And so by the time we started 2020, we were at record few inventory before the pandemic. So this year, though, will be, now the 4th year post-pandemic, 3rd full year post-pandemic. And so we could indeed get back to the old normal levels of inventory. So when we look at inventory levels, that is, there's the total number of unsold properties. There's also the number of new sellers in a given week. So new listings in a given week. And so inventory can build when demand is weak, people aren't buying, then inventory builds. But it's also important how many people are selling. And it's important for a couple of reasons. So when a lot of folks are selling and inventory is building, that is a weak demand, high supply environment. And those are recipes for price changes. On the other hand, in the past few years, each line here is a year with each week's new listing count. The bright blue line is last year, and it was relatively low. The very low gray line, that was 23, very few sellers all year, slightly more sellers last year. and we are growing slightly more sellers in 2025. So at the left end of the chart here, you see the 25 line is taking shape. Just a few, like 3% more sellers this year than last year. I am watching this new line to see the dark blue line for this year to see if it goes the trajectory of the gray lines from the years past. So 60, 70, 80, 90, 100,000 sellers in a given week. When there's 100,000 sellers in a given week, there's a lot more sales that need to happen. There's a lot of demand to happen. So a lot more transactions happen. When there's only 60,000 sellers in a week, that means fewer transactions can happen. So even if demand is weaker, like the watching the number of sellers in a given week is really a strong signal for us. So this week, 46,000 new listings. It ticked sideways this week rather than going up, which is kind of people are holding back, waiting to see what happens signal. But there were like 3% more sellers, more listings unsold than a year ago this week. So just slightly more. And I expect this year that in general, we'll have more sellers all year long, maybe 5 to 10% more sellers all year long. Inventory gains are not evenly distributed across the country. And if you've been watching these webinars in the past few months, you've noticed that the South has had inventory growing, the North has had less inventory growing. And right now, so the darker the blue here, the more inventory growth over last year, 25 versus 24. What's interesting is actually the far New England, Vermont, and Maine actually have the most inventory growth year over year compared to previous years, where the Midwest, upper Midwest, and New England, like New York and Connecticut and Illinois, all the way through like Minnesota and North Dakota, have very little inventory gains. For some reason, North Dakota has fewer homes for sale than a year ago. Is the only state with fewer homes for sale than a year ago. But in general, what's been happening is we would sell in Chicago to buy in Dallas or buy in Phoenix. We would sell in New York to buy in Florida. And in the past couple of years, we've stopped that migration pattern, dramatically slowed that migration pattern. So post-pandemic, during the pandemic, we sold a ton in New York and bought in Florida. Post-pandemic, we slowed way down. So we're not selling our homes in New York. We're not buying them in Florida and Texas as much. And therefore, the inventory is tending to build across the Sunbelt states. If you've been watching the webinars in the past few months, though, you would notice that just a few months ago, Arizona was like 60% more homes on the market than a year ago. Texas was at 50%. Florida was 60% more homes. And now these are 30 or 40%. So it's evening out a little bit. It's smoothing. Its inventory is growing in the north just a little more than it was last year and not growing as quickly in the south. So we are having inventory gains that are much more, not much more, slightly more balanced across the country this year. And I believe that's because we've delayed now for 2 or 3 years those moves. I think that it'll even out even more if rates come down and it makes it easier to move. There's another factor in here with employment. So it's not just selling houses. It's actually, unemployment's very low, but normally when unemployment's low, we're confident enough to quit our jobs. We're not quitting our jobs right now. Companies are not hiring very much. So everybody is staying in place. So I'm not quitting my job in Chicago to move to Dallas. I'm not quitting my job in New York to move to Florida. It's not just the housing market. It's also things like the employment, the labor market. And we've called that the great stay. We're staying in place. I got a good deal. I got a good deal on my mortgage. I've got a good job. I'm afraid to go give that up to try something new. So we're in that mode, at least for another year, but hopefully it balances out and we see a little more rebalancing, a more flat blue across the whole country. 8 states now have more homes for sale than early 2019. So again, these are the big pandemic boom markets. You can see the lavender ones here. have more homes for sale. I think it's really interesting. It's like Texas, Oklahoma, and Arkansas have a lot more homes for sale, where Florida is actually just at 5% more home sale than that for sale than in 2019. Um, a lot of building in some of those like Texas markets, uh, Colorado and Boise. Those are California inbound migration markets. So those slowed way down. Um, when we look at a place like Boise, Boise had a ton of inventory growth, and it was one of the hottest markets during the pandemic from folks moving from places like LA. And one of the things I will be watching for this year, post fires, is does a town like Boise or Salt Lake City, do they regain some of that pandemic momentum from folks who are displaced or are afraid of Los Angeles? And so those destination markets may have some growth this year from folks who said, well, I can go buy a house in Boise and I can't even rent a house in LA right now. There may be those kind of things. Now, they're not in the data yet, but that's what I'm going to be watching for. So it'll be fascinating to see if like Colorado and Idaho, even a place like Austin, Texas, which had a lot of inbound Californians, if those will shrink during the year. Okay. Um, let's talk about the projection of inventory. So we're looking at forecasts. So we're expecting inventory to grow by another 15% by the end of the year. It's up 25% now, so we'll see some compression there. And so in this year, the dotted line is the rest of 2025. You can see the blue line is the curve from 24. And the top gray line there, that's 2019. So we can see we're getting much closer to the 2019 levels by the end of the year. Basically, in 2026, we'll be back at the old normal levels of inventory. This assumes that mortgage rates stay roughly in the sixes this year. You can see that if they're in the sevens, inventory will probably go faster. If for some reason rates fall into the low sixes or under six, I expect that we'll see a lot of demand stimulated. Demand increases faster than new sellers supply, so you'll see inventory tighten during the year. It's really hard to envision scenarios where mortgage rates are back under six for very long. But that would be a scenario where we would revise down our inventory forecast for the year. As of right now, through January, inventory is basically on track to what we expected when we released this forecast in a few months ago. And so it is, one of the things I'll watch for next week. We can see that there is still in the dotted line at the left end of the chart, there's a downticks, usually into February, before inventory hits the bottom, before it starts climbing for the year. If inventory climbs next week and the week after and isn't bouncing along the seasonal bottom, that'd be a real signal about higher rates lead to more inventory because houses are less affordable. We sell them more often. We hold fewer of them. So that means inventory builds. So that's what our forecast looks like for the rest of 2025 in inventory. So I mentioned that sales, so let's switch back to sales. At the start, I mentioned that home sales are, this week were 10% fewer than the same week a year ago. In the fourth quarter, sales, and this is measured by newly pending sales, so the contract started each week. And we could see that in the fourth quarter, sales were up about 5 or 8% each week over a year prior. In January, they've been coming in below, and this week they were 10% fewer sales, 45,000 new contracts started. And it's hard to imagine anything that's going to tick that in the data that's going to tick that up by our report by next Monday. Rates are still high this week. We also had weird weather stuff across the South. So I don't see any catalyst. So I'm imagining that next week we're going to come in with fewer contracts started again, and we'll be on our way. Now, like as I mentioned, we'll be We still forecast 5% home sales growth for the year. But if we roll into March and we're still under, we're going to have to revise that forecast lower. And it'll be really fascinating to see because, the bulk of the work happens in March, April, May, June in the housing market. So then let's look at the total number of homes in contract at any given moment. So, we were looking at the new sales each week, but sales take, right now they take about 45 days to close on average this time of year. And so 30 or 45 days. So you get 4 or 6 weeks of those new sales coming in lower. And overall, we had more homes in contract at the far left end of the chart, 2025, and more homes in contract than 24. But now, after a few weeks of weak sales, there are fewer homes in contract than last year. So this is like the overall number. You can see the 22 line, how many, there was like a third more homes in contract to close. You can see in the gray line also how quickly that dropped in 22 in July and again in September, October, because those were the big mortgage rates the first early mortgage rate spikes of 22. And you can see in the bright blue line in September, October this year of 24, the sales kind of went horizontal. They held up better in the fourth quarter, and that's where we started to see our sales gains. But now rates jumped again, and so we're back underperforming for last year. It's not an optimistic sign, and I wish I had better news, but that's where we are. Okay, so let's switch now from sales to prices. Home prices, as measured by the price of those contracts that are started this week. So the price of those 45,000, the median price of those 45,000 new contracts was $375K this week. It's at the left end of the chart here, the navy line. That's just 0.5% above last year at this time. So these are the homes that are going into contract. They're going to spend 30 or 45 days in contract. They'll close. Some of them will close in January, some will close in February or March. And so when you start seeing the sales numbers, the headlines will start reporting lower and lower percentage of home price gains by January and February. Most of the headlines, the numbers like the Case-Shiller Index or Fannie Mae has one, or NAR, show home prices for 2024 ended about 4 to 5% up above 23. And you can see that at the right end of the line, at the right end of the chart here. The 24 line is above the 23 line. It was 23, finished just up a little bit above 22. 22 had these, in the middle of the chart, the two gray areas. Home prices adjusted very rapidly in 22 when consumers were first shocked about rates. Now rates are higher, but they aren't changing as much. In September of 24, rates fell to 6, and you could see that prices adjusted up very quickly. So people were buying, they bought quickly, the sales increased, and prices held firm through the end of 24. That was a surprise to me how quickly consumers put a floor on prices when mortgage rates got to 6%. Now we're at 7 at the back at the left end of the chart with a 25 line starting. And suddenly there are essentially no home price gains over last year. There aren't any signals in the data of broad home price declines, but there are lots of local markets where home prices are ticking down. They're less than year. Like if we're nationally up just 0.5%, there's a bunch of markets who are below last year, even if there's still a bunch of markets that are above last year. There's no signal in the data of like a massive, like a downturn like we saw in 22. I watch very clearly I watch for those every week, and those are important signals, but there aren't in the data right now like these big dips that we saw in June and again in September, October of 22. Now, if we look at all of the homes on the market, these are the asking prices. So if you walk into the market today, the median price of all the homes that are available is $420,000. That is essentially exactly the same price as last year at this time. So normally in the spring, home prices are ticking up each week. with fresh inventory, with latest demand. And so these are the asking prices, right? So these are the homes that are on the market. And when there is, and you could see that through 22, the gray line, in the spring of 22, we were still finishing the demand from the pandemic. Everybody knew that mortgage rates were rising. And so the prices that were being paid and were being asked was still climbing each week. They peaked in June, and as of July 4th, consumers said, we're done. Of July 4th of 22, right in the middle of 22, right in the middle. And then prices declined quickly in the second half, so that you can see the gray line for 22 fell quickly in the second half of the year. So now, though, we're starting with no gains over 24. And so we are in a scenario where we could, in a scenario where rates stay high all year, you could imagine where across the country we have a negative price year. We had moments of negative prices year over year. You can see that June of 22 was still in terms of the asking prices in the US, still the highest point was June 22, was $455,000. And each of the past 2 years, we have not exceeded that again. We're not on pace to exceed it again this year because of where we're starting the year. And so really 3 years have not recovered on home prices. If rates fall, then you could imagine that these kick up. But the demand side, the pending home sales prices moves quicker than the ask side in either direction. Now, looking at the map again, which we talked about how each state, in the South, the Sun Belt, had more inventory growth and fewer buyers moving from the North. If you look at the price appreciation, now you can flip it around. The Midwest and Northeast are the darker states, are where home prices have climbed more. So in New York has barely more inventory than at the pandemic lows, and therefore demand has the most competition, and home prices are at this moment up 16% over a year ago. Illinois is 12%. So it's a really fascinating. Now, many of these markets that are in like 2, or Texas is at 0.9%. All these markets are essentially flat. You should think of them as flat. 2% up or down can bump around in a week. It's like home prices are essentially flat across that part of the country. The signals are, there's no bullish signals in the data. There's no crash signals at the macro level, the state level, but you can really see where the price appreciation is, because that's where we're not selling homes. We're selling fewer homes there. So the people who have waited in Buffalo for 3 years now say, you know what, I've got to buy a house and there's still not much for sale, so I'm going to buy a house. Buffalo is affordable. So many of these Midwest and Northeast markets are much more affordable than the boom markets of the Sun Belt. And so, it's much easier for somebody to buy a $300,000 house there than a $700,000 or $800,000 house in Austin, Texas. So that's what we've been looking at across the states. And this will moderate a little bit this year, but I think we're in general should expect roughly the same pattern as we saw a year ago. And this is starting to get out into the zeitgeist. So I have a friend who I ran into last weekend, and he was flying from California back to Buffalo because he had a house that his mom owned, that he's inherited, that he's had for a bunch of years. And he said, wow, for the first time in a bunch of years, I can sell this house. So he's flying back to Buffalo to prepare that house to sell. So I think there will be more folks like that, where it is the first opportunity in a long time to be able to sell homes. So I think you'll get a slightly more inventory there. You'll get slightly less price appreciation, and you'll see a little moderation across the states this year. All All right, so let's look at the price cuts, and then we'll switch over to some of the local markets in the Altos system. So we're looking here at the percentage of homes on the market with price reductions. And each line is a year. In the spring, you get fresh inventory. So at the right end of the chart, you get fresh inventory. Fresh inventory doesn't do a price cut until it sits on the market for a few months. So then it's by maybe April or May. If you haven't gotten your offer yet, now by June, you're definitely doing price cuts. Usually then in the fall, before the holidays, you might do more, you might do another, or more people would do a price cuts. Then it resets over the holidays. So you get homes that withdrawn over the holidays, you get fresh inventory again in the spring. So you get this normal seasonal pattern. Each line here is a year. And the lines that are at the very bottom, those are the pandemic years. You can see 22 crosses everybody, started with record few price reductions, meaning in every market, there are sellers who overprice and they need to cut their price. And usually it's about 30%, a third of homes are overpriced. And sometimes that's intentional, sometimes it's accidental, sometimes it's a seller that's fishing for offers. It doesn't matter. Every market has price reductions. When the market is super hot, like during the pandemic, a third of homes are overpriced, but some of those fishers get their bites and they get their offers. And so only 15%, a third of homes are overpriced, but only 15% have to do a price cut because some of those folks got their offers. Now we're starting the year, 33.5% of the homes on the market right now have price reductions. That is higher than last year. So the bright blue line is last year. And it's also flattening much quicker. So you can see the gray lines in most of those years, the gray lines ticks down very abruptly. You get more new listings in January and February. And then it's not until April before price reductions start ticking up. But this week we had some, you get some new listings. And so there were about 40 basis points fewer than a week ago. So it was 33.9, now it's 33.5% of the market. But normally that'd be falling, it would have been like 32.5 this week, but it's only, and then 31.5 next week. So it's much more flat. And that's because the folks that are on the market, even though there's fresh inventory, more of the folks that are on the market had to do price cuts this week. And if you think about it, there's 10% fewer contracts started than a year ago. So 45,000 instead of 49,000 new contracts started this year. There's 5,000 people, 4,000 or 5,000 people who didn't get offers. And those folks are now asking themselves and asking their agents, do we need to do a price cut? When you are talking with buyers and sellers, the price cuts are a very powerful way to understand the local market. It's a very powerful way to understand when you're listing a house for sale, if you're selling it, if you are leaning into growing demand or weakening demand. So what we can see right now is nationally that there are slightly more price cuts and they are declining at a slower rate this spring, which is because there's less demand. So for a seller, it's the question, a new listing is, do you want to be in front of this curve or behind this curve? In 22, when this gray line jumps in 22, it was, March in 22, and we could watch it starting to break away from the previous year. And, at that moment, we were jumping up and down saying, this price reductions curve is kicking way up, and you don't want to be overpriced in July in this market at 22, and because you can see it coming. And so price that house properly now to get ahead of this curve. That's the power that the leading indicators of the price cuts, right? So a house is on the market now, doesn't get an offer in January, it does a price cut, and later in January, maybe it gets an offer in February, that closes in March, and then you start hearing about it in April. But you can see right now what's happening in that market. So this is the national number. The different local numbers behave differently. Some local markets, like a place like Phoenix, typically has 40 or 45% of the homes take a price cut. In Phoenix is normal. So when Phoenix is cold, it's a 50 to 60% price cuts. When Phoenix is hot, it might be 15%, but normally in Phoenix is 40. So we'll go switch over now and we'll look at the local markets, and we'll look at a few of those elements, and then we will wrap up. So let me see. I've got the Altos system open here. I have our advanced analytics platform open, and I've got a bunch of ranked charts that I like to use to keep track of. I have the price cuts in the middle. Right now, we can see Indianapolis, Tampa, Denver. So here's Denver, Phoenix, here's the Western markets, and then here are the Florida markets. So these are the Sun Belt markets that you notice those were the ones that were highest inventory change. They were many of the ones that have more inventory than 2019. They were also the markets with the lowest price growth this year. And what this is telling us is that these are set up there's no bullish signal in these price cuts now. In other words, there's no difference in that trend happening. Like, we could see the best prices are in the north, the weakest pricing is in the south, and that looks set to continue based on the current active market. One thing I did notice was, notice that Dallas is pretty high on the rank, and Austin currently has fewer price reductions than Dallas. In Texas, in the post-pandemic 3 years now since the pandemic market changed, the first one that got hit the hardest was Austin. Austin had inventory shoot up. You could see in the fall of 22, 62% of the homes in Austin had taken price cuts, was very slow. Austin prices ticked down year over year and maybe haven't found a bottom yet. But what's interesting is that Dallas looks weaker relative to Austin. Now, it's like the power is shifting. The emphasis is shifting to the Dallas market from Austin in the last year. And I suspect that Austin had a big shock of like California migration stopping and things like that. So maybe that's evening out a little bit. And Dallas is a much more diverse market with people moving in from all over. So as of right now, I think it's an interesting thing that Austin has for 3 years been sort of the worst Texas market, and Dallas has kind of bumped over that on the list. And one of the things I like watching is this inventory level per state. Texas has 110,000, 111,000 single family homes on the market. This is a rolling 90-day rolling average, but you could see, just a few years ago, 40,000, and now there's 111,000. You could see Florida and you could see how inventory is climbing on all of the states, except that look at New York. So New York is still basically in the same pattern as it has been for 3 years. Inventory has not been climbing. New York has slightly more homes than a year ago, but it's still in a horizontal pattern as opposed to a directly rising pattern like so many other states. Illinois, Chicago had a strong pricing year. So Illinois is in that same New York pattern in terms of available inventory. Here's New Jersey. New Jersey is in that same pattern. So you can really see how that has changed. Okay, I got a bunch of local markets open. I'm going to dive into them. I'm going to start with Buffalo, New York. Buffalo is, I think Zillow named it the number one, the hottest real estate market in the country. This is now the second year. And it goes with all the themes I've been talking about this year. So here, this hour, Buffalo, here's inventory in Buffalo. Right now, 1,000 homes for sale. So there's actually fewer homes for sale in Buffalo than a year ago. And here's the weekly. I'll use the 90-day rolling average here, the smooth chart. And you could see, 1,500 at the beginning of 2020 is now under 1,000, so a third fewer homes, and that dropped even more from 2019. You can see it in Buffalo. Let's look at price reductions in Buffalo. So Buffalo is right in its normal range of price reductions. So for Buffalo, that's 25, 30%, 35% of normal, and so slightly more price reductions than a year ago, but still in a very healthy range. And we can go look at the price segments in Buffalo, and you can see exactly where the demand is, right? So at the second price segment, the middle upper of Buffalo is $300,000. It's an affordable market. Inventory is tight, and so days on market is only 42 days. Anytime you're getting to something like 600,000, now it takes much longer to sell, or you get down to the stuff that is down here at 200,000 or lower, and these are older houses. They're small, they're on small lots, so significantly less desirable. Takes, again, 70 days to sell. So you can really see where the demand is in Buffalo and why Buffalo is one of the hottest markets in the country. But now let's switch to Miami. So Miami on our market action index, barely, it's like balanced market, buyers and sellers, meaning like we haven't seen a real buyer's market in a long time. That market action index is low and falling. We can see, though, here's the median list price in Miami. Prices are down year over year in Miami. And if we look just at the weekly numbers, like I'm not sure we've found the bottom yet in Miami. And then if you look at, and let's just look at inventory real quick in Miami. So inventory in Miami is way up over the pandemic. It is back into the normal range pre-pandemic. And then if you look at the time to sell in Miami, they're all over 70 days. Remember, in Buffalo, only the weakest market, the weakest segments in the whole area were over 70 days. So a dramatically different market in Miami. And we've been selling in Buffalo and buying in Miami for a decade or 2 decades, and we've slowed that way down. And that's what you can see in the data here. I've got Las Vegas open. So Las Vegas is also much cooler on the market action index. Vegas had a big surge in inventory at the first part of 22. Vegas and Phoenix had this reaction in 22. So inventory spiked very quickly. And for much of last year, inventory was lower year over year in Vegas. Now it's up year over year. So it's normalizing a little bit, starting to climb back up. And you can see that in like every price segment in Las Vegas is over 70 days. Let's look at the price reductions in Vegas. So, Vegas had in 30 normal 30% range after the immediately in 22 when stuff really started tanking. So it was up to 55, 56%. We're back into the normal range for price reductions in Vegas right now. So a little more stable than say Miami, for example. Home prices are up year over year, but there's no growth. Like these are the previous years. Prices were climbing reliably. In 22 to 23, prices were down 1 year, up last year in 24, and up a little bit in 25. So a much more stable market in Las Vegas. I want to switch to, we talked about a few Texas markets, but San Antonio is a really interesting one to me. In one of the biggest policy shifts we're in for this year is the immigration change. And San Antonio is obviously an immigration market. And so it'll be really fascinating to see what happens to housing demand and supply in San Antonio over the next year. Now, what's happening is already, because like many of the Texas markets, build a ton in San Antonio, It was super hot during the pandemic. It cooled way off. And so inventory now in San Antonio is 30% higher than it was pre-pandemic, right? In 2019, 2020, there went from 9,000 to 13,000 single family homes on the market in those few years. So there's already a lot of supply in San Antonio. And it's going to be really fascinating to me to see if we can see, we can see it probably in rental demand, but if rental demand is down, does that mean that more people are shifting to buy? Like they tend to move together, buying and renting, like it's household formation. So if we're taking households out of the market, it's going to be really fascinating to watch what happens to demand and supply in San Antonio over the next year. San Antonio is already a cool market. You can see in every price range, 77, 80 days, 110 days. And we can see the pricing in San Antonio is down for 2 years in a row now and hasn't yet turned back up. So something to absolutely keep in mind, and it'll be one to watch for the year. Okay, I'm gonna stop with there. I can't get to all of the markets, of course, every day. You can go to altosresearch.com, and there's a box now to get a free report. You actually get an Altos account. You sign in, you get your account, you can get your local market data for any zip code, city in the country. I encourage you, if you have not already done that, I encourage you to do so. That allows you to get book time with our team and talk about your local market and talk about how you can communicate this market to your buyers and sellers right now. So go to altosresearch.com and go grab that if you haven't done so already. Okay, that's all the time we have for today. I'll stick around in the chat for a few minutes. We'll make sure all the questions are answered. There is a recording, and you will get emailed and that later on. You can share that with everybody, and we will see you again real soon. Thanks, everyone.